The German stock market is on fire. The DAX just broke above 18,000, an all-time high. Headlines celebrate the comeback of the German economy. Politicians claim the worst is over, and analysts say the bull market is back. But here is the question nobody wants to ask. Is this rally real or dangerously misleading? In this video, we'll take a closer look at why the DAX is rising, what's happening beneath the surface of the German economy, and why the current optimism may be based on shaky ground. Let's start with the basics. Yes, the DAX is up, roughly 10% in Q1 2025 alone. But what's really driving that growth? It's not broad-based, it's not the real economy. In fact, it's mostly a handful of large-cap stocks, SAP, Siemens, T-Mobile, Allianz, that account for a disproportionate share of the DAX's gains. These companies have global business models and strong earnings. That's true. But does their stock performance reflect the health of the broader German economy? Not really. Here's what the real economy looks like. GDP growth in 2024 was just 0.2%, essentially flat. Industrial production has been declining steadily, especially in manufacturing, chemicals, and automotive. Germany's exports to China, once a key growth engine, fell by over 12% last year. The ifo Business Climate Index remains at recession-like levels, so we have a disconnect. The stock market is booming, while the economy is barely growing. That's not unprecedented, but it should raise red flags. So why is the DAX going up? There are three main drivers. 1. Interest rate expectations. The European Central Bank raised rates to fight inflation, up to 4.5%, but now markets are pricing in rate cuts. That has fueled a rally, especially in tech and growth stocks like SAP and Infineon. 2. Lack of alternatives. Europe may be sluggish, but for many global investors, it still looks more stable than China, the US tech sector, or emerging markets. So money flows into large, dividend-paying German blue chips. 3. Passive investing. Millions of retail investors are buying into DAX ETFs via savings plans and investment apps. These automatic inflows push prices up even when fundamentals don't justify it. It's the momentum effect, and it works until it doesn't. Now let's talk about the risks. On the surface, the DAX looks healthy, but underneath there are serious structural challenges. 1. The German real estate market is cooling fast. Property prices have dropped 7 to 10% in many urban areas. Construction permits are down. Mortgage lending has dried up. High interest rates are putting pressure on borrowers and developers alike. This isn't a crash, yet. But if unemployment rises or interest rates stay elevated, defaults could increase. And that would hit banks hard. The banking sector is vulnerable. Deutsche Bank and Commerzbank have stabilized, but their profitability remains low. Smaller regional banks, especially those exposed to commercial real estate, are under pressure. And in a high-rate environment, any negative shock could escalate quickly. 3. Geopolitical uncertainty. Germany is highly exposed to global trade, especially with China and the US. Any disruption, a renewed trade conflict, sanctions, or military escalation could hit export-heavy sectors like autos and machinery. 4. Aging infrastructure and labor shortages. The German economy is facing structural headwinds, underinvestment in digital and transport infrastructure, an aging workforce, and a shortage of skilled labor. These aren't short-term risks, but they weigh on long-term growth expectations, and investors know it. So where does that leave us? This is not a doomsday scenario. A crash isn't guaranteed. But a 10 to 20% correction, entirely possible, even healthy, in the next 12 to 18 months, especially if corporate earnings disappoint or global conditions worsen. Let's imagine. The DAX falls from 18,000 to 15,000. That would wipe out the last year of gains and hit passive investors the hardest. Many retail investors, especially those in long-term ETF savings plans, are now exposed to market volatility they didn't fully expect. So what should investors do? First, stay rational. Don't chase all-time highs blindly. Understand what you're invested in and why. A diversified portfolio is key. Second, stress test your assumptions. What happens if interest rates stay higher for longer? If China slows further? If earnings shrink? Third, Follow real indicators, not just stock prices. Pay attention to fundamentals, earnings, cash flow, debt, and macro trends. Don't rely solely on media hype or momentum. Conclusion: the DAX is strong, but the German economy is not. That doesn't mean a crash is coming tomorrow, but it does mean that the risks are rising, and the gap between perception and reality is growing. As always, the best investors are not the most optimistic or the most pessimistic, but the best informed. If you found this analysis useful, consider subscribing. On this channel, we break down markets, risks, and economic trends without hype, just facts, logic, and perspective. Thanks for watching, and stay informed.